So, what if I tell you that some of the most powerful investors on Wall Street have figured out a way to make money even when the companies are going bankrupt? And no, that's not by short selling or maybe betting against the market, but by buying something that most people have never even heard of. That is called credit default swaps. And by the end of this video, I'll make sure that you understand exactly how it works, why it was revolutionary, and why some people believed it helped cause the 2008 financial crisis. Stay with me, this one is worth understanding. Let's say you have 10 crore rupees of your hard earned money, right? You are looking for opportunities to invest in. You come across a company which, to be honest, looks quite promising. So what happens, you give them 10 crore rupees today and company promises you to pay back with interest over the next 5 years, right? For the 10 crores rupees that you gave them, they will issue you a bond for the same amount, right? But you know the human mind. You might start to wonder about things like, what if the company actually begins struggling? What if before the 5 years it totally becomes bankrupt? Who is there to protect your money, right? So don't you think it would be nice if someone sold insurance against that risk as well, right? And this simple idea actually became one of the most important financial innovations in history. See, the problem was that companies can default, right? The environment is so dynamic that anything could happen. And the problem with companies being defaulting is that lenders could actually lose everything. So the idea was that someone should come forward and offer protection, right? Maybe the bondholder could pay a fees and they could get compensated if a default happens. So the innovation was made, which is called the credit default swap, and it became a tradable contract. So the problem is, the Wall Street never takes it easy. Wall Street never really stopped. What happened was, people started buying insurance on debt they didn't even own. Just for you to understand it more efficiently, let's imagine you are buying fire insurance, not for your house, but for your neighbor's house. So when there's a fire in your neighbor's house, you are actually the one who will profit. You don't actually own your neighbor house, but again, you will be understanding that there is a profit if that burns down, and which is the essence of credit default swap. So, why lenders often worry about default? So, basically, what happens is, let's say there's a loan of 1 lakh rupees with a 10% interest. Your expected profit would eventually be 1 lakh 10,000. So, basically, this 10,000 is your profit, right? This is the maximum that you can have. But if the company defaults, repayment is absolutely zero. The entire capital that you invested is zero, it is gone, you have nothing left. So the risk that the borrower fails to pay back what they owe is called credit risk. This is a possibility. Every lender faces this risk. Credit risk is faced by every lender, be it bank, pension funds, investors. It's basically a fundamental problem of lending, right? So, how do you insure a loan? See, what happens is, we buy insurance for our cars, houses, and people. When maybe if our car gets into an accident, we are compensated for the maintenance of a car, right? If our house is burned down, we are compensated for that as well. If we are investing in life insurance, in case of death, we getting compensation for that. So if there are insurance for cars, houses, and people, why can't we insure bonds as well? Right? But how would you do that? Banks, pension funds, investors, they are basically billions in debt. So how would you basically reduce their default risk? So that's where the birth of CDS come into picture. Let's understand the basic structure of CDS. You are a bond holder. This is how our problem statement started, right? You basically want protection from default, right? You are basically the owner of the debt, which is the bond. So what you will do is pay a premium to whom? the CDS seller, the default swap seller. What the seller would do would take on the risk. They would collect the premium income, and if there is a default, only and only if there is a default, they will basically compensate you. The bond owner will be compensated for the same thing, right? So if you're having trouble understanding what basically swap actually are, let me explain you with a simple example. See, let's say there's a businessman A, and uh, basically let's say a businessman A and his friend B. This businessman A is very risk averse, right? Right, and this B is a risk taker, right? So he's a businessman. What he does is that he basically, what is happening, let's say the interest rate for his loan keeps on, let's say a loan of 1 lakh rupees, right? So the interest amount usually every month changes from, let's say, 5 to 7%, right? So some months he's paying 5,000, some months he's paying 6,000, some months he's paying 7,000, right? Now B is a risk taker. He always is looking for some business opportunities or arbitrage or speculation in which he could benefit, right? The problem with A is because he's very risk averse, he wants his accounting to be quite smooth, right? So he's actually having trouble, a lot of trouble in budgeting because of the change in interest payments. So what happens is they enter into a swap contract in which what happens is A agrees to pay B 6,000 rupees no matter what the interest rate is, right? No matter what the interest rate is. So when the interest rate is 5,000 rupees, B is actually getting 6,000 rupees and he is benefiting 1,000 rupees. If it's 6,000, he's getting 6,000, he's having zero advantage. If the interest rate is 7,000, he's getting 6,000, the loss is 1,000 rupees. So basically, because he was risky, he was ready to take into consideration this arrangement, and maybe for the next year or months the interest rate could stick to 5,000, so he would be easily gaining 1,000 rupees every month. So this is basically what a swap agreement is. Whatever insecurity A had, it was swapped with B. This is how a swap basically works, right? So again, this happens like the bond owner, he wants to protect his debt capital, so he'll pay a premium to the CDS seller, who in case of default would compensate the bond owner the entire money that he invested, right? Otherwise he'll just enjoy the premium. The bond owners pay small fee which is called a premium and receives protection against the default. It's a financial insurance, but the implications are much deeper. Let's understand how. See, this is what it looks like. 100 crores bond value, 2% CDS spread or premium, right? The premium that we talked about, we can also call it CDS spread. So annual premium paid would be 2 crore rupees per year. Let's say the bond is for the 5 years, right? So what will happen? The benefit for the CDS seller is that if the company is not having any default, he'll be able to earn 10 crore rupees in 5 years just from the premium with no obligation. Yes, of course, if the company finally defaults, he would have to pay 100 crores. But there's a upside and downside as well, right? So now we'll try to understand why CDS and how CDS basically changed finance and what was the real breakthrough. So what happened before CDS was that risk and ownership were tied. They were a single entity. What do I mean by that? If you are owning a bond, right, you are owning the risk that is associated with that, right? You can't really separate them, right? If you are selling the bond, you are selling the risk. You can't really sell the risk as a tradable commodity, right? What happened with CDS? Now owning a bond and risk was a different thing. You can own the bond, you can have all the benefits that a bond has, and you can transfer the risk by paying some premium to someone else. If there is a default, your risk is basically transferred to that CDS seller, right? So you are basically enjoying all the benefits of the bond, and with a small premium price you are basically transferring the risk as well. So ownership and risk are basically now separate products that can be traded independently. So what CDS did is they basically created separate products. One was the asset and other was the risk. So we were able to trade in risk with CDS, right? So finance learned how to sell risk independently. So the credit default swap basically allowed investors to separate their credit risk from the debt ownership. This was bond. This was the probability of default, right? So it transforms default risk into a tradable financial asset. But what is the perspective of CDS? See, here we are noticing that even after 5 years, he would be only gaining 10 crores, but in the case company defaults, he has to pay a large amount of 100 crores, right? So, why are they doing it? Right? For that, you have to understand the logic of the insurance companies as well. What happens is, what insurance company basically does, they collect premium from a lot of houses. They have a very diversified pool of investments, right? So what happens is, yes, fires could occur in house, fire could be there in house, they could burn down the entire house. But if you are having 100 diversified portfolios, the chances of default would be 1 to 2% only. The rest of the premium is your profit, right? So what CDS seller basically thinks about is that this particular borrower probably won't default. They are taking the green side of that. They can collect 2% premium every year for 5 to 10 years. If no default happens, they can keep all the premium as profit, right? For 10 years it will become a 20 crore rupees profit, right? And this is, see, here we are thinking about one asset only. What if there are multiple bonds? From one you are earning 20, let's say you are 5, you are earning 100 crores, right? From maybe if you are 6, you might be earning 120 crores, right? What if in 10 years one of them defaults? You are liable to give 100 crores, you are still leaving with 20 crores. This is how basically insurance companies actually survive, right? So let's now understand about the CDS spreads, right? It is basically called the market fear meter, and we'll understand why it is called, right? Let's say the CDS spread is 0.5 and not 5%. See, why would someone ask more premium? Be honest about it. Think rationally. When someone is asking for a less premium for a particular company and higher premium for the other company, what is happening? Market believes in that company, right? There is a much more chance that the company A is much more safer, right? But company B is riskier, so the premium would also rise, right? So because company A is safer, so the protection cost is also low. But because company B is riskier, the protection cost is high. So higher risk is higher premium. The spread basically reveals what the market truly believes in. If the company is confident, if the markets are confident for a particular company, the CDS spread is going to be less. And if the CDS spread is high, the market would believe and make sure that this is, CDS spread is high, and basically it would represent that the company is riskier. So now take a note. If you want to understand about a particular company, you can understand and look into the indicator CDS spread. If the CDS spread is higher, it means that the market believes that there is risk associated with this particular company. If the CDS spread or the premium is low, then the company is optimistic about that particular company, that the market is particular. Now let's talk about naked CDS, right? This is basically what is controversial. See, what was happening with traditional CDS was you basically own that particular bond, right? You buy protection on your own debt. But what happened in naked CDS, you're basically buying protection without owning the debt. Now go back to the example of the fire insurance that I gave you for the neighbor's house, right? You are buying fire insurance for your neighbor's house. You don't actually own your neighbor house, right? But if it burns, you are getting paid. This is called naked CDS. Now CDS become a way to bet on default. You're not owning your debt, you're not owning that particular bond, but you're actually betting that someone is going to fail. So you don't have protection against it. You're just speculating, you're just betting on the default. Right? Now, see, I told you that CDS could act as a indicator in action. You can read about what happened in Argentina, Greece, and with the Silicon Valley Bank, and how credit markets and the CDS prices were basically visible before these bank failures and sovereign debt crisis came into picture. Right? So CDS markets were often revealed to be under stress before the headlines actually told you that something is wrong. So, what happens is, if we understand CDS, what is happening for the individual investors, CDS is nothing else but helping you reduce the credit risk on your specific holdings, right? This is the micro level. But for the financial institute, what is happening is, it is basically enabling efficient risk transfer, right? Maybe if we talk about a pension fund, if they are betting onto something that could default, and they are basically handling money of a, they are basically handling the retirement funds, right? So you don't want to be in a risky position when you are handling something so delicate, right? So this would basically help them make sure that they're benefiting from the bonds, and with a small price they are basically transferring the risk. So this is what and how it is helping for at the meso level. For the macro level in the global system, it is creating a pricing mechanism through the CDS spread. So for the default risk itself, right? So CDS is basically, it can't and nothing can eliminate risk, right? It just transfer, it is just moving the risk, right? At its core, CDS is basically a financial insurance, right? So this is a one word answer for what CDS is. It's basically a financial insurance. But the real innovation wasn't the insurance. The real innovation was making the default a transferable risk. Before CDS, you were not able to transfer the risk that you have on your holding. But after CDS, this was made possible. And once risk became the product that could be bought and sold, this was the starting of a new market. This entire CDS spread and it being an indicator, it just made sense for everything, right? So, in modern finance, there is not just a money trade that is going on, right? We are also betting against the possibility of failure. We are transferring the risk of failure on our holdings, or maybe speculating and making sure that we are benefiting from failure as well. We have understand and talked about short selling as well, how that could be done, but again we have another measure in which we can transfer risk. So a CDS basically allows investors to separate their credit risk from the debt ownership, and default risk is transferred to a tradable financial asset. So let's go through some formulas which are essential for the CDS mathematics. So let's say we have to calculate the CDS premium. So we have the bond value which was 100 crore rupees, and the CDS spread which is the premium, so 2 crore rupees. This is no more than but basically the same. So notional is basically the face value of the bonds that you hold, the entire principal, the portfolio, multiplied the spread. This is basically the same thing. So what is the expected loss, right? We'll calculate the probability of default for that, right? And exposure is nothing else but the principal that you invested, right? What is the discovery rate? So what happens is, when there is a default, right, when company defaults or they are considered insolvent, or maybe uh, they are filing for bankruptcy, what happens is rest of the remaining assets are sold. So there might be a case for your 100 rupees bond, because they sold their asset, they have some money that is left, so you can get 40 rupees back. So that 40% would be your recovery rate. And if you have a CDS, the 60% would be covered by the CDS seller, right? So this is how things actually work out, right? So if you have really made it this far, I'll really want to thank you, because this was actually a very complex topic. And if you really want to keep going deeper into finance with me and understand more about these hidden instruments, the structures, and the story behind the Wall Street, I'll request you to subscribe, like, and comment about other topics that you want to talk about, and maybe any doubts or maybe examples that you want me to focus more into. Thank you so much.